Welcome to Unlocking the Upside. I'm Geoff Robinson, founder of theinvestmentanalyst.com, and
I'm James, ex-buy-side analyst and now full-time wrangler of Geoff's metaphors.
Today we're talking about how the market still gets soaked in a storm it saw coming. Trump's April 2025 tariffs were telegraphed, even time-stamped, and yet the market whiplashed like it never saw it coming. Why? We're going deep on modeling blind spots, sentiment shocks, and what analysts keep getting wrong about risk. The market's just experienced their biggest shock since 2001, with the Nasdaq surging 12% in a single day. And here's the crazy part. Everyone saw it coming months in advance.
That's fascinating. You're talking about the 2025 tariff crisis, right? When Trump slapped that massive 104% levy on Chinese imports?
Exactly that. And what makes this so mind-bending is that it wasn't some surprise announcement. Trump had been broadcasting these moves for months, practically giving a play-by-play of what he was planning to do.
You know what this reminds me of? It's like watching someone walk straight into a glass door while reading the "Watch out for glass door" sign.
Laughs. That's actually perfect, and it gets at something really fundamental about how markets work, or rather how they don't work. We have all these sophisticated tools and brilliant analysts, yet we repeatedly fail to price in risks that are literally staring us in the face.
So what exactly stops these professional analysts from accurately modelling something they can clearly see coming?
Well, there's this fascinating psychological element at play, something called optimism bias. Even the most seasoned professionals tend to believe things will somehow work out better than expected. But there's also this whole structural problem with how analysis works in the financial industry.
Tell me more about these structural problems. How do they affect decision making?
Think about it this way. If you're an analyst at a major firm, what happens if you're the only one predicting doom and gloom? Even with solid evidence, you're essentially putting your career on the line by going against the consensus. It's like being the one person at a party saying, "I think that's a load-bearing wall," while everyone else is swinging sledgehammers.
That's quite a vivid image. So there's actually a professional disincentive to call out obvious risks?
Exactly, and here's where it gets really interesting. The models these analysts use are incredibly sophisticated for crunching numbers, but they're surprisingly primitive when it comes to factoring in human behavior and market sentiment. It's like having a supercomputer that can calculate the trajectory of every raindrop, but can't tell you if people will bring umbrellas.
Well, that certainly explains why the market seemed so unprepared for something they knew was coming.
And there's this fascinating concept called reflexivity, introduced by George Soros, that makes everything even more complicated. When people start believing something bad might happen, they take actions that make that bad thing more likely to occur. It's like a self-fulfilling prophecy on steroids.
So in the case of the 2025 tariffs, how did this reflexivity play out?
The fear of economic disruption led to market sell-offs, which then affected business confidence and economic indicators, which then justified the original fears. It's this fascinating feedback loop that traditional models just aren't equipped to handle. Think of it like a crowd rushing for the exits. The panic itself creates the very danger people are panicking about.
That really challenges the fundamental assumption that markets are rational and efficient, doesn't it?
Absolutely right. We've built this entire financial system on the assumption that markets will efficiently price in all available information. But what we're seeing time and time again is that human psychology plays a much bigger role than we want to admit. It's like we're trying to predict human behavior using nothing but a calculator.
Speaking of psychology, how do these cognitive biases affect the way analysts process information?
There's this fascinating phenomenon called anchoring, where people rely too heavily on the first piece of information they receive. So if markets have been stable for a while, analysts might have trouble adjusting their expectations even when they're seeing clear signs of upcoming turbulence. It's like trying to convince someone their house is on fire while they're still comfortable on the couch.
That makes me wonder, what should regular investors take away from all this?
The biggest lesson is that you can't simply assume that obvious risks are already priced into the market. Just because everyone knows about a potential problem doesn't mean the market has adequately prepared for it. It's like seeing dark clouds gathering and assuming someone else has already built the ark.
So how do we fix this problem? What's the solution?
That's where things get really interesting. It's not just about building better mathematical models, though that's certainly part of it. We need to fundamentally rethink how we approach risk assessment. This means creating environments where contrarian views are not just tolerated but encouraged, developing models that can better account for human behavior and market sentiment, and perhaps most importantly, accepting that some degree of uncertainty is inevitable.
You know what's particularly fascinating about this? How it might change the way we think about expertise in financial markets.
Exactly. Maybe we need to start valuing different kinds of expertise, not just the ability to build complex mathematical models, but also the ability to understand human psychology, political dynamics, and social trends. It's like adding a sociologist and a psychologist to a team of mathematicians.
And what about the role of technology in all this? We have more data and better analytical tools than ever before.
That's actually part of the problem in some ways. All this technology might be making us overconfident in our ability to predict and control market outcomes. It's like having a super powerful telescope that can see deep into space, but still missing the asteroid that's right in front of us.
So what's the key takeaway for the future?
I think we need to embrace a more nuanced understanding of how markets work. Yes, they're powerful tools for processing information and allocating resources, but they're also subject to human limitations, institutional constraints, and psychological factors that can't be easily quantified. The 2025 tariff situation wasn't a black swan event. It was more like a grey rhino charging straight at us while we convinced ourselves it wouldn't really hit.
That's quite a sobering thought for anyone involved in financial markets.
Indeed it is, and perhaps the most important lesson is this: sometimes the biggest risks aren't the ones we can't see coming, they're the ones we see coming but fail to take seriously enough. In the end, maybe the best strategy isn't trying to predict every market move perfectly, but building more resilient systems that can handle the surprises we know are coming, even if we don't know exactly when or how they'll arrive. Before we wrap up today's episode, let me share something I'm passionate about: Insight One. I built it to bring institutional level investing insights to everyone, blending decades of Wall Street experience with adaptive educational technology. It's not just another platform, it's where deep market wisdom meets interactive learning. Available now on the App Store, Google Play, and at theinvestmentanalyst.com. If you want to think like an institutional analyst, start your journey with Insight One.